Hi there, good morning. This is Victor, and I'm the Head of Investment Advisory at Sankore Global Investments, and this is your weekly financial markets roundoff. We start off in the US, where stocks capped off another week of record closing, which were essentially buoyed by Donald Trump's win of the US presidential election. On Friday, the Dow added 0.59%. The S&P was up about 0.33%, while the Nasdaq was up marginally by about 9 basis points. Now, if you look at the week in general, the three averages finished at record levels, with the Dow and S&P wrapping up their best week this year. The S&P was up 4.66% for the week. The Dow rose about 4.61%, while the Nasdaq advanced 5.74%. This rally that we saw last week was very, very broad-based, such that the Russell 2000 surged about 8.56%. Investors basically, view a Republican government as, being supportive for businesses, particularly around expectations for deregulation and obviously an extension of the 2017 tax cuts. However, concerns over the large, federal deficits and also increased tariffs have, continued to spark inflationary fears, which is certainly likely to limit the extent to which the Federal Reserve can, ease rates. Also, last week, the Federal Reserve met and, eased rates by 25 basis points, a unanimous decision, which was essentially in line with, expectation. There are expectations of a further 25 basis points cuts in December. I think for the Fed, the debacle really going forward is essentially determining the neutral rates. That's the rate at which that rate isn't necessarily supportive or restrictive, for growth, and it has to do this against the backdrop of a fiscal dominance, really, increased taxes, increased government spending, so lower taxes, increased government spending. All these, increased tariffs as well. All of these have implications for inflation, and the Fed will have to tread very carefully to ensure that its easing cycle does not become, significantly inflationary, as the fiscal side seems to be pushing on the inflation front. Again, I think another critical thing that really moved markets last week was the fact that investors really just don't like uncertainty. So the fact that the outcome was clear. We weren't dealing with, maybe a contested election, because before going into that election, it was really neck on neck. It almost felt like a coin toss. So right now, the fact that uncertainty is out of the way has created quite some positive sentiment, and we've seen the market run up quite, significantly. Going into this week, market basically will be looking out for, inflation data, which will be released this week. That could also provide some, pointers as to how the Fed is likely to react next week. It also give us an indication of what's happening to price stability across the U.S. economy. Now, it really remains to be seen if this rally that picked up last week would continue. I mean, historically, after the elections, we typically see a positive market sentiment basically through the end of the year. Nevertheless, investors will need to, like I said earlier, reckon with the impact of the sort of policies that we expect, from a Trump presidency, and its impact on the rate decision of the Federal Reserve going into 2025. Over in Europe, the BOE also cut rates by 25 basis points. This is its second rate cut this year. However, did that with the backdrop of raising inflation forecasts, as a bumper budget proposal announcement by the Labour Party, essentially looking to stifle the potential for further rate cuts. The BOE now sees inflation rising higher by about 0.5% than previously estimated to somewhere around 2.75% for next year, while it expects growth to increase by about 0.75% next year. Again, I think just like what the Fed is basically facing, major challenge for the BOE will be to navigate, the inflationary impact of Labour's new bumper budget proposition, and aligning that with benchmark rates, really. That proposition essentially is looking to significantly raise taxes and also increase spending. This obviously would have implications for the inflationary outlook, and by extension would also have implications for how quickly the BOE might be able to cut rates and its rate path essentially going forward. Over in Germany, The ruling coalition in Germany basically faced some uncertainties last week as the German Chancellor Olaf Scholz fired the finance minister, essentially threatening an already fragile, coalition. So, and this action last week led to, although the finance minister has been replaced, but this led to heightened calls for snap elections and also a confidence vote on the chancellor. And this basically should pave way for federal elections as early as March next year. Those elections were actually initially scheduled for the fall of next year, but it looks like those elections might come quicker as this coalition is essentially looking to falter. Over in China, it announced a 5-year 10 trillion yuan package to tackle local debts, as it signaled, more economic support would likely come next year. This program is expected to take effect from this year and will run through 2028 for around 2 trillion yuan a year. Local debt had grown to around 22% of GDP by the end of 2019, and it continues to be a significant burden, for China, really. The Minister of Finance estimates that this policy to raise 10 trillion yuan over the next 5 years would significantly contribute to reducing local government hidden debts, which is estimated anywhere around 14 trillion yuan at the end of 2023. The expectation is that this debt will reduce to about 2.3 trillion yuan by the end of 2028. Now, this move is really, really huge if you compare to recent debt resolution efforts that we've seen in the recent past. This effort is by far, the largest, that the government is undertaking. It really remains to be seen how this would significantly impact things going forward. The local governments are still leading with, quite some debt. This program essentially is akin to like a debt swap program that enables these local governments to access more debts to pay down on some of the principals or some of the loans that they've been carrying. That would essentially then free up capacity for them to be able to borrow more and then be able to funnel all those funds into more productive activities of the economy. Over in Nigeria here, the fixed income market last week, sentiment really started out mixed, at the beginning of the week. But, the announcement of an OMO auction in the course of the week, just before Wednesday, created some negative sentiment in the market as, participants were, looking to or anticipating higher yields. The OMO auction was quoted by the Central Bank of Nigeria. Wanted to sell about 300 billion, but got subscriptions of about 1.4 trillion, and about 1.4 trillion was sold. And that's quite huge if you look at it in context of the sort of size of OMO transactions that have been done recently. Also, we had a PMA auction last week as well, which was oversubscribed by about 156 billion. And we saw stock rates increase actually significantly across board. The 90-day paper closed at 18% discount rates. We saw a 100 basis points increase from the previous auction. The 180-day paper closed at 18.5% discount rates. We also saw a 100 basis points increase from the previous auction. While the 1-year paper closed at a discount rate of 23%, we saw a 235 basis points increase from the previous auction. And in the aftermath of the auction, we saw, yields move up, and we saw significant demand for that 1-year paper, which then created some sort of moderation around yields for the 1-year paper. So going into the remainder of this week, really, we're looking to inflation data in the US. We also expect inflation data here in Nigeria as well to pretty much set the tone for what we're likely to see in terms of monetary policy, going forward. I think that's pretty much it in terms of our, market update and roundoff. We hope that you have a very, very productive week. Thank you very much.